mainstream financial media is feeding you a dangerous narrative about the 2026 Middle East shipping blockade. They are pointing to recent ceasefire memorandums and telling you the global supply chain threat is over, but if you have money in the market, you are walking directly into a trap. Welcome to Geo Capital Vantage. While everyone is distracted by the price of crude oil, a completely different geopolitical bloc is quietly using this shipping paralysis to trigger a massive, artificial supply shock in a critical agricultural commodity. If you don't know what this asset is before the third quarter hits, your portfolio is going to take a massive hit. We will reveal exactly what this commodity is and how the smart money is playing it at the end of this breakdown. But first, you have to look at how global trade was just permanently rewired. For the first time in modern economic history, the world's two most critical shipping lanes, the Red Sea and the Strait of Hormuz, were simultaneously blocked. Politicians are announcing that the waters are reopening, but maritime intelligence doesn't move at the speed of press conferences. The waters remain highly contested, and war risk insurance premiums for cargo ships are still astronomical. Major shipping companies are not taking the risk. They have fundamentally abandoned the Middle Eastern shortcuts, forcing massive cargo fleets to take the grueling, expensive detour around the Cape of Good Hope in Africa. This detour is quietly destroying global shipping capacity. In fact, it has effectively removed up to 7% of the global container fleet's capacity from the market. But the loss of ships isn't even the most expensive part of this crisis. There is a new, hidden European carbon penalty that is about to absolutely crush profit margins, and we are going to break down exactly who pays that tax in just a moment. First, let's look at what this detour is doing to your baseline freight rates. Because ships are trapped in 14-day longer transit loops around Africa, ocean freight rates have absolutely exploded. By late June 2026, the Shanghai Containerized Freight Index, the gold standard for global shipping costs, surged past 3,200 points. A standard 40-foot container moving from Asia to the US East Coast is now costing upwards of $7,800. But remember that hidden European carbon penalty I mentioned earlier. Here is how it works. Under the new Fuel EU maritime regulations, when a shipping company diverts around the Cape of Good Hope, they burn significantly more fuel. For a standard massive container ship, taking the long route doesn't just mean $500,000 in extra fuel. It triggers over $160,000 in combined European carbon taxes for a single voyage. And that cost is passed directly onto the consumer and the companies you invest in. If you want to understand exactly how these carbon taxes are restructuring global energy grids, make sure to check out our deep dive playlist, linked in the description below after this video. This disruption triggered a massive panic among US importers. Fearing both the shipping delays and a new wave of tariffs, companies rushed to front-load their inventory. They compressed the entire global shipping peak season into a massive bottleneck, overwhelming available capacity. But while retailers fight over cargo space for consumer electronics, the real devastating blow is happening in a completely different sector. It's happening in the fertilizer market, and it is about to permanently rewrite global food prices. Let's look at exactly why the Middle East holds the keys to your grocery bill next. The most critical vulnerability testing global markets in late 2026 is the agricultural supply chain I teased at the beginning of this video. Modern food production is entirely dependent on nitrogen fertilizers, specifically urea and ammonia. The Middle East accounts for roughly 40% of all global ammonia exports. When the shipping lanes were blocked during the crucial Northern Hemisphere planting season, it severely disrupted the export of these exact fertilizers. You cannot simply skip a fertilizer cycle. Even a minor reduction in nitrogen application results in immediate, devastating crop yield declines. The fertilizer shock of early 2026 is baking irreversible costs into the agricultural sector. The United Nations Conference on Trade and Development recently released a stark warning about this exact secondary shock. The cost to grow, harvest, and transport global food supplies has been permanently elevated. So, here is the commodity trap, and exactly how the smart money positions itself when global trade is rewired. You stop looking at standard consumer equities that rely on cheap shipping. You pivot your focus to the base commodities trapped behind these geographical blockades. Industrial metals, agricultural inputs, and critical energy derivatives are seeing massive price revaluations. Companies are operating on dangerously thin inventory margins, and fixed income markets are adjusting as institutional investors brace for inflation to remain higher for longer. The winners in this new economy recognize that supply chains are now being planned in war rooms, not boardrooms. If you are getting value out of this breakdown and want to stay ahead of the markets with us, make sure to hit that like button and subscribe. We are building a real community of investors here at Geo Capital Vantage who look past the mainstream headlines, so I want to hear from you. Drop your thoughts on how this blockade is affecting your own portfolio down in the pinned comment below. Like, subscribe, and I will be down there reading through them. Finally, if you want to see exactly how all of this connects to what we broke down in our last upload, click the video on your screen right now to see how these exact shipping fractures are directly impacting global copper reserves. I'll see you over there. Thanks for watching.